Guys, we have the 5 best leap options to buy in 2024. This video is going to print a lot of money for you because leap options have a lot of leverage. They're way better than just stocks. They're way better than just call options in the short term. Leap options are long-term call options that you can buy and make multiple X on your money if the stock goes up. So I'm going to show you the most bullish stocks that I think are going to rise, that I think are value stocks as well as growth stocks at the same time, because a growth stock that goes down is no good. A growth stock that has some value component to it, has good momentum, good brand, you can definitely buy some call options that are leaps and benefit in the next 6 to 12 months. So a leap option is a call option that is 6 to 12 months, okay? Many people will say it's over 1 year. For me, it just means long-term. So a long-term call option that you buy for very little, right? You put fractions of $100, $200, you get to control 100 shares. The amazing thing is you get to control 100 shares, you get to put up very little capital, and you have a huge leverage factor. So if the stock goes up, you will make absolute bank. So let's go over some of my top plays that I think are very smart right now to put your money into. Now, specifically, I'm also going to go over what the return could look like, how to manage this position, when to close this position, because so many people don't understand when to close. And we're just going to go through some real life examples. So let's jump into my screen right now. I do have a few stocks. First stock I do want to cover is going to be Apple. Apple is one of my favorite investments. I do have a lot of my money currently in it. This portfolio specifically, I have 60% of my money in Apple stock. So we are investing in Apple. I currently don't have any leaps. I'm just running the cover to call strategy. However, if I had a smaller portfolio, if I had a medium portfolio, and I couldn't really buy hundreds of shares of Apple like I have here, 7,000 shares, here's what I would do, okay? I would go into trade Apple options, and I'm going to be picking a call option. I'm going to be picking a call option that is going to give me the upside benefit of the stock as it rises. Now, for Apple, this is probably a $200 stock in the next couple of years. I really don't know. The good thing about a leap option is you don't have to bet on something happening in the short term. You get a lot of benefit with low time decay. Let me explain what this looks like in a real example. So I'm going to go to an expiration date that is going to be well into the future. So let me just go for example, March 21st, 2025. So this option, 2025 expiration, is almost 360 days out. So it's about 11 months from expiration, okay? So we have a whole lot of time. Now you want to go for an in the money option. You can go out of the money, that's perfectly fine. But an in the money option gives you that upside, okay? What I mean by that is when the stock goes up by $1, this leap option is also going to be very sensitive, okay? It's going to be rising a lot as well as falling a lot. So it is a double-edged sword, as all things are in life. With trading, okay, this is a double-edged sword. However, if you're bullish, and in this scenario, I pick a stock that you're bullish on, this is going to be fantastic in terms of getting a huge reward for very minimal risk. So let me show you what this looks like right now. I'm going to pick something in the money. So let's go to 155, just randomly picking this. But as you can see here, the delta is 0.75, which is exactly what I wanted. I wanted something between 0.7 to 0.8. Now, you can go for a higher delta, but if it's 0.9, it's going to be a little bit less risk to reward ratio, okay? You're going to be risking a little bit more because it's a little bit more expensive. As I go down for more in the money options, they just cost more. And if I go for something that's out of the money, well, sure, it costs a lot less, but at the same time, I'm trying to run a proper leap strategy. For me, this is also good to have a 0.7 because you can later turn this leap call option into something else like a poor man's covered call. I have a video on that. Let's just focus on leaps for now. I'm going to go to the 155 right here. I'm going to explain to you what is happening, okay? So if I go ahead and buy the 155 here, you will see that I'm going to have to pay $2,900, okay? Let me explain. So if you were to buy 100 shares of Apple, right, you would have to pay about $17,000, okay? Because 100 shares times $169.91 is about $17,000, okay? But with this call option, you're only paying $2,900. So instead of paying $17,000, you're paying about $3,000, which is, basically 5 times less. So you get to put in about 20%, get to put in 20% of what it would cost to buy, 100 shares. However, in this scenario, if the stock goes up and you have a break even here at 184, let's just say that by March, it's going to go up to 190, okay? So if the stock goes up to 190, you'll actually be in the money by about $7. Now, you're actually going to be in the money by a lot more. You're going to be in the money by $35, but because you've paid $29 in premium, it's going to be the difference, okay? So the break even right here is 183. So if it goes to 190, you just take the difference. You take 190 minus 183, you get a $7 return. So you get $7 versus, what you put in, which is 29. That return is going to be about 22% right now. It's about 22%. So you get a 22%. The stock only has to go from 170 to about 190. That is about a 10% return. So if the stock moves about 10%, you get about a 22% return. So that's where the leverage factor comes in. If you bought stock, it goes up 10%, you make 10%. With this leap option right here, if the stock goes up by 10%, you get 20%. Now, let me tell you, I'm just giving you a very simple scenario. If the stock were to go up 20%, let's say it went up to $200 per share, now this becomes very, very interesting because at $200 per share, you make $17. You make 17 because it's 200 minus 183. You get $17. You only put in 29. Now, all of a sudden, you're getting over a 50% return. Okay, the stock goes up 20, you get over 50. So you have a really good leverage factor, and it actually goes like this, okay? So you get a leverage factor. Basically, the more the stock goes up, that option goes up even more because you only put up a small amount of capital. So your percentage return is actually really huge. So I would do this on Apple right now. The next stock that I'm going to pick is going to be something like a PayPal. Okay. So PayPal, granted, they've had issues. I get it. But if you look at, let's say the 5-year chart, this stock was trading at some crazy levels. I mean, back in 2021, this was a $300 stock. So if you were to buy a call option right now, I would buy a call option. Actually, in this scenario, I would probably go out a little bit out of the money. You can buy an in the money call to get a lot of sensitivity, but you can also put up a very small amount of capital. So for example, I'm going to go to, let's say December 19, 2025. So this is almost 2 years, like a year and a half or whatever. You can actually go for an out of the money option. So 65. The current stock is trading at almost $65. So this is basically an at the money option. If I were to show you the delta right here, the delta is 0.65. It's actually pretty high. The reason why the delta is so high is because even the market understands that over a almost 2-year period, the stock is likely to rise. So it is factoring in a pretty high delta here of 0.65. Now, specifically what can happen here is if PayPal basically goes up, you need it to go up to about $80 to see a break even because you're paying $16 per contract here. So you need to be 65 plus 16, so it's basically 81. But if this position goes to $96, which is not absurd, that's a 50% rise. Then here at $96, you're basically going to double up. Okay, you're going to double your money because you put in 16, your break even is 80. At 96, you make another 16. Now look, this is where things get really interesting because since you put up 16, you needed to go up by another 16 from 80 to 96 to double your money. But to triple your money, then you need to go from 96 plus another 16. Okay, so that's going to be 112. That's to triple your money. Another 16 is going to be 128. That's to quadruple your money. You can 4x your money, you can 5x your money in this position right here because you have a huge leverage factor. You also have a lot of time. So PayPal would be my second pick right here, Apple and PayPal. Now, next is going to be a little bit controversial. I'm going to show you guys Nvidia because specifically, I know there's a lot of Nvidia bulls. I'm kind of neutral on Nvidia right now since it pulled back. I was pretty bearish on Nvidia when it went up to like over $900 per share. I get it. There's a lot of innovation in this company. And in the long term, actually, the valuation isn't too bad. Like the PE ratio is pretty high, but at the same time, this is one of the fastest growing stocks and there is a lot going for it. So you could buy a leap option. So on Nvidia, you can buy a leap option that would also expire well into the future. Whether you go for a 6-month option, a 12-month option, an 18-month option, a 2-year option, it really depends on you and your view. Like, where do you think the stock is going to go? How much time do you think it needs to get there? Like what kind of catalysts are there? So for example, for Nvidia, maybe they have to have another GPU. They have to have some more, more earnings events. Okay, earnings is obviously a really big deal for all stocks, right? Once earnings comes out, there is a big shift in expectations. And the market is basically just an expectations game. What did you expect to happen? What does the market expect to happen? If that's different, the market will react, right? So if, everyone thinks that Nvidia will have $6 earnings per share and it comes out with 12, it's going to rise a lot in value. So what you can do is you can just go out very far in terms of date. Let's say September 19, about 500 days away, over a year. You can go for, let me show you 2 examples. So you can go for like a Hail Mary football play, right? Not a biggest football watcher, but let's just go for a Hail Mary, right? That's when the quarterback just throws that ball like as far as possible. It's like he needs to make a touchdown fast, right? So you can go for something like 1,000. You can buy 1,000 call option. Now look, maybe Nvidia goes to $2,000, right? Unlikely. It's going to be one of the hugest companies, probably will be the biggest company actually if it were to triple in size. It's unlikely, but there are people that believe a stock like this could do that. I mean, it doesn't even have to go to 2,000. It can just go to like 1,200. Here, your break even is going to be 1148. So you can get a 33% return if it were to go to 1,200. Now, if it were to go to about 1,400, that's where you would double your money, because the rule to double your money with this strategy is basically to look at the break even and to add the premium that you pay. So, the break even's 1150 and then you're paying 150. So 1150 plus, 150 is going to be, actually it's going to be 1,300. So 1,300 here would be your double up point. And then from there, you would add another 150 to see where you would triple up. So this strategy is really amazing. You do need some patience for it, because if the stock doesn't go up in the short term, you might be thinking to yourself, should I cut this position? Should I get out of this position? Well, I would say that if you still have belief in the stock and that is showing some positive signs, or there's some events coming up, there's some innovation coming up, the CEO is talking positively about the company, then it may make sense to just hold on to this position. I wouldn't say you would want to hold on to expiration, because in some cases, if you've already had a really nice move, let's say you've made 50%, 60% on your money, you may be happy. You may decide to cut this position for a gain at that point. The next stock I'm going to be talking about is going to be Meta. So just in general, I really like technology companies. Obviously, tech companies have a lot of growth and they typically do outperform the market. A company that is growing very quickly is very good, but also a company that pulls back from its recent highs is also a very good investment. So what I like here is Meta has a lot of momentum. Here, what I would do is I would bet on that momentum continuing, because we just had a pullback. So this looks like a really good entry. You can even see here, there's a little bit of a pickup point right here, okay, in one day. So there seems to be a really good pickup point. In fact, if I go to something like Yahoo Finance, I want to show you something that's really important, okay? For me, when I was working on Wall Street, one of the most important factors that I've noticed and that I've talked to quants about, by the way, a quant is somebody that does quantitative analysis on the market, is momentum, okay? So momentum is one of the most important things. And basically momentum is this. Momentum is how much is a stock moving up. What does that momentum look like? Is it moving in the positive direction? Is it moving in the negative direction? And how fast is that happening? The rate of change. That's basically some calculus, but you don't have to be a super genius to understand this. Just simply go to the chart and you want to look at something like RSI. So here you can see the RSI is 31. For me, when I look at a stock and I'm looking at the RSI 30, that level is oversold. So for me, Meta is looking oversold. So buying a leap option could actually be pretty good in the shorter term, because you may decide that in this example, I think it's going to pull back up sooner than later. So I may see a gap fill. Okay. Essentially, if I go into the chart right now, if I go to 3 months and I turn this line into a candlestick, you can see that there was a gap down. So typically when there's a gap down, that gap typically gets filled back up. That could take a month, it could take 2 months. So in this scenario, I would essentially just buy a call option that would be expiring a little bit shorter term. So you don't have to always go out long term. So on Meta, I would pick something like, let's go for August, okay? So if I wanted to fill this gap pretty quickly, and by the way, I'm gonna show you a little bit of interesting variation right now to this leap strategy, okay? What you can do is you can buy, for example, just a little bit in the money. So 445, 55 delta right here, you can buy this. Now, let's say that we think that the gap is going to get filled, but it might not necessarily like rise to the moon again. We just think there's going to be a gap fill. So we may fill this gap back to even these support levels right here, these previous support levels before the gap fill. We can see here that, if I zoom in a little bit closer, that this level, you can see how the intraday lows, that's what this candlestick is kind of saying here. The intraday lows were about 475. So let's say that we fill the gap back to 475. We kind of, cure a lot of the investors that were pretty bullish on this before. Maybe they're going to start buying it up. Okay, if we kind of go back to this support level before the gap fill, we can say that it's going to be about a $475 stock in the next, 2, 3, 4, 5 months. We really don't know. I think in 2-3 months that could very realistically happen. So what you would do in this scenario is you would then sell a call option. Now I'm showing you a little bit of a variation here in the leap. This is technically going to be called a bull call spread. I have videos here in my playlist, which you should definitely check out if you want to become a master at option trading. By the way, I also have a Discord community. I put all my trades there. You can follow along if you wish. It's the first link in the description. Now I'm going to show you this variation right now. It's going to be a sell call And like I said, we think it's going to be about 475. So in this scenario, actually, you get a very, very favorable risk to reward ratio. You're essentially potentially can lose $1,270. But the beautiful thing is that you can make $1,730, essentially 1.5x on your money in the next 112 days. So this is roughly, 4 months. You get a roughly 4 months to 1.5x your money. Very, very powerful strategy overall. This makes Meta my third pick. Now for my fourth pick, I would pick something for 2024 that I just have a lot of belief in. Maybe it doesn't have the most volatility, but I have a lot of belief. So for me, that would be something like Adobe. Adobe is a fantastic company and I've been looking at it for a long time. In fact, my videos are edited through Adobe. It's the Creative Cloud. So essentially Adobe has a lot going for it because it actually has AI that is a big positive factor in this company. And AI is just a really good trend. We've actually seen Netflix rise a lot as well as fall. Palantir, we've seen Nvidia, we've seen a lot of companies that are associated with AI they just rip it, right? Because AI has a lot of benefits, cost benefits. There's a lot of innovation benefits. Just overall, AI is a really, really good play. And Adobe is a really good stock overall. Specifically, Adobe has a really consistent recurring revenue. Once someone's on Adobe, they typically don't get off. And, just taking a look, we're going to take a look at the technical analysis right now. After earnings, this stock had a little bit of trouble. It pulled back quite a bit. And if I go to the chart right here, you will notice that over the past 6 months, this stock has been in a little bit of a downtrend. Now, this would be kind of considered buying or catching a falling knife. But for me, it's really worth it. If you can catch a falling knife of a really good company at the proper price, you don't even have to get the perfect price. You just have to buy it at a decent price. For me right now, buying call options on Adobe makes a lot of sense. And I would say that this is easily a $500 stock. I think it can even be $600 because this stock was trading at, the $600 level for a little bit of time actually. So it was trading from basically early November, right? Early November to this year in 2024. So I think in 2024, maybe 2025, this is easily a $600 stock. So I would just buy a call option. In this case, I would probably buy something. Let's go for the end of 2024. So you just go for December 20. So again, whether you go 6 months, 12 months, you just need your catalyst, your story to play out. As long as your story even goes in the right direction, then you're going to be in good shape. So I would say that you can go for something like the 500 here. Your break even would be 548. Okay, so you would double your money essentially if it were to hit 600. Now you could double your money at 600, or you can also go for something in the money. So if I were to go for 450, this would be in the money. Here you would actually slightly more than double your money. Okay, you would slightly more than double your money. So you actually get a little bit more benefit on the 450 if it hits 500. Sorry, if it hits 600. Now, if it goes a lot higher, then you actually benefit more from going out of the money options. Okay, so if you were to go for like a 570 and this stock went up to 650, you would multiply your money many times. So you have to just do the math and see what makes the most sense, because it depends on where you think the stock can end up at. And you want to do some simple math there. Now, the fifth stock, you can go for something really kind of more interesting. You can either go for something like a NEO. Now, for me, NEO has sold off so tremendously. So I think that right now it makes a lot of sense. I actually just made a video on NEO not that long ago when it was under $3 per share. So we've already made about 12% in the past week by buying NEO under $3. But I still think that this stock has more room to run. I wouldn't really be a huge buyer of NEO in like large amounts because I still want to use proper asset allocation, risk management. I just don't want to have too much China exposure. But at the same time, the level that it's at right now just is too good to ignore. So I would go, basically, if you look at it, by the way, it's trading for the same level as cash. It's literally costs the same as cash. That's not factoring in the brand. That's not factoring in future sales. A lot of things that's not being factored in. So I would just go for like a January option right here. And I would just buy something like the $5 call. This would be slightly out of the money. The delta here is pretty high. The bid-ask spread is phenomenal. Phenomenal bid-ask spread for a smaller cap stock that they have really good volume. I mean, 1,000 volume is fantastic. So I would buy a call option here. This is pretty much a leap call option. And then I would wait for it to hit something like $6 per share. Now, in this scenario, I may not hold until expiration. If NEO continues to go up, which I made 12% in a week. Okay, in a week on the stock. Okay, so in a leap option, that's going to be 20%, 30% in a week. That's insane. This strategy is a lot more powerful than I'm making it seem. I've been telling you this strategy is really powerful, but it's actually even more powerful than you think so if the stock has a short-term move. So if NEO goes up short-term by 10, 15%, you're gonna see a huge rip in that leap option. So what I would do is I would actually close out this position. If it were up 12 to 15% in the short term, I would probably take my profits, roll it into something else, or heck, maybe I would hold on to this stock as well. If honestly, I would probably hold on to it because I do think that it has more upside. I think the stock could potentially go up to $6 per share. But in the meantime, if it hits $5.50, I would start to take profits along the way. So if you want to level up your trading, if you want more plays like this, then just make sure to check out my description. I'm more than happy to coach you. And thank you so much for watching.